Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we will be discussing hedging your cryptocurrency portfolio, part 4 of 4. Perpetual swaps. Perpetual swaps, or just perpetuals, have recently grown in popularity. More and more cryptocurrency exchanges are starting to offer them. Their use is quite similar to that of investment futures, however, it does have some differences, mainly the periodic funding rate, which is usually 8 hours, and there is no expiration date. Why would you want to use this method? The key reason for using this method are the same as with using futures. The main difference would be that the short funding rate means that the perpetual swaps closely track the underlying prices, much closer to the futures. On the other hand, this also means that your hedging cost may vary, as funding rates are readjusted every 8 hours. Not having to deal with rollovers reduces your trading costs as well. How do you construct this? The portfolio construction is exactly the same as the inverse futures. Check out part 2 of our series to see how to construct this hedging method. The only difference is that you will need to have an account or an exchange that offers perpetual swaps. Just like hedging with futures, hedging with swaps is best suited for cryptocurrency investors that carry the standard coins rather than the ones that are well diversified. It is also for the investors that want to hedge their exposure efficiently. A good understanding of perpetual swaps is highly recommended, as you will need to assess the risk of using financial derivatives fully. Pros and cons are mostly the same for futures, so this table will list the differences between the two. Why do people hedge? Most investors in the cryptocurrency industry probably want the exposure, as they expect their favorite crypto to go to the moon. In some cases, they might want to stay safe for certain reasons. Those reasons are dependent on what position they have in the industry. Miners. Miners need to pay their electricity bills as well as other costs in USD for their native currency. For this reason, they might want to have more predictability on their capital returns, but it may be more beneficial for them to stock up on their cryptocurrencies and sell them in one large batch periodically. This way of selling cryptos is better, as they can negotiate better fees and reduce certain transaction costs. Therefore, miners will generally hedge to reduce their risk while they are piling up cryptocurrencies to sell them in bigger batches. ICO Projects. ICO projects often incur various costs in US dollars. They often have a need for more predictable cash flow, which is why they might want to sell cryptocurrencies they hold. However, they do not want to be seen to be selling their own tokens or funds, as they could be interpreted as weakness. This sends a bad vibe to the investors. ICO projects hedge their funds to keep cash flow more predictable while maintaining the trust of the investors. Funds. Certain funds employ strategies that are based on a return that is relative to Bitcoin. In this case, they would have to overlay their portfolio with a Bitcoin equivalent hedge so the returns they get become relative to Bitcoin's performance. Whales. Selling a significant amount of cryptocurrencies is not as easy, as it can cause market fear. Whales need to make sure to not cause big market drops when wanting to cash out. Therefore, their alternative would be to put hedges in place. This reduces their overall exposure as they slowly sell off their holdings over a longer period of time. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.